Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. M.V. Srinivasan, VP at Mecklai Financials, joining in. Welcome to the show, Mr. Srinivasan, and a pleasure always to speak to you. Let my first question come to you with regards to, what everyone's talking about right now. Veteran bankers are saying that the Indian credit market is worse than what we've seen in 2 decades. What would your view be on the same?
We have had a very difficult last 2 years. Mainly, even before the COVID, we had problems with the credit markets. And after the COVID started, it has worsened further. And, we have incidents like the Franklin Templeton, which has actually affected the risk taking ability of the investors. So it will take some time for the credit markets to pick up. And to start with, the government should spend more on capital expenditure so that the credit market picks up. And it will be followed by the private players. So I don't see probably next 1 year, it's not going to be a very good investment to make in credit risk investments. So that's going to be very difficult.
Right. So, is it right to say that this is one of the most challenging times for the bond market, and our market has actually taken quite a few steps backwards?
Yeah, it's a very tricky situation. You see what is happening. The Reserve Bank is having a lot of things on hand. To start with, they have to. They are actually looking at a growth-oriented approach instead of inflation targeting. That is one. Second is they have a huge amount of liquidity on hand. See, we started with the 6.4 lakhs surplus in the banking liquidity, and it slowly, gradually increased. And today it is standing at around 11 lakhs 40,000 crores. It has to be managed by the Reserve Bank now. And it is very clear from whatever has been happening since the beginning of this year. The 14-day repo transactions that the RBI has been conducting, the rates have been coming down from 3.55 to slowly. The latest one was conducted in August, end of August, which actually came in at 3.38%. That is on one side. So the Reserve Bank is definitely not comfortable with the excess liquidity. And since July, the Reserve Bank has also introduced that variable real-time repo operations. And so far, including, excluding whatever they have done in the GSAPs, about 50,000 crores they have taken out from the system. Apart from that, they have also done primary, secondary market operations. In addition to that, variable repo rate operations they have been doing since August period. This month alone, they have kept around 7.5 trillion as a target to mop up excess liquidity. Even that may not be enough to bring the liquidity back to normalcy. Because at the moment they take more liquidity out of the market, there is again FX intervention, unsterilized intervention is taking place because of the huge amount of FX inflows. So that money comes into the system again. So it's a kind of roller coaster ride the Reserve Bank has to do. It's going to be a tough thing, but one thing is very clear. The Reserve Bank is not comfortable with the kind of liquidity there in the market. If you see the previous meeting, one of the members has dissented. Because of that, the bond deal, which has been falling down, has been arrested. And now, if in the next meeting, if another person dissents, maybe that is the end of the lower bond yields. Might be slowly it may start picking up. And now on hand, Reserve Bank has to employ the other instruments like MSS bonds, the special deposit facility, these kind of things they have to implement now to take out the excess liquidity from the market so that at least it will become controllable and yields will remain stable.
Right. So overall, if you go to see with regards to where the long-term bond buyers go, if you talk about, say, pension funds, insurers, they have been opting for liquid notes from states rather than corporate securities. Are you expecting this trend to continue for some time now? And that's something which could keep impacting the demand as well?
No, initially, I don't expect the long-term yields to move anywhere.
Hmm.
It will be holding even beyond 10-year yields are not going to move anywhere. Whatever the Reserve Bank is doing will only affect the short-term markets, say up to 5 years. So initially, I would expect the 5-year bond yield to go up approximately 25 to 30 basis points towards 5.9% or whatever it is. And then only once the liquidity normalizes and the RBI is comfortable, the long-term bond yields will start rising. Other only the question of investment in long-term is whether it is right or not will happen. In addition to that, if you talk about the pension funds and all these people, they are all investors globally, but the bond yield in India is very attractive now compared to the global bond yields. And for at least for the next 2 years, we are not seeing a substantial rate hike in any of the developed markets. US also still it is dithering, whether it is going to be 2022 or 2023, which where is going to be the first rate hike. So on a long-term basis, still our yields are very attractive. That is why our pension funds are still with us.
Right. And if we see the sales data as well of rupee bonds, the ones which are rated below AA have almost, I think, dropped 20% so far this year. And this is the lowest.
Audio problem. I will put you on the computer audio.
Sorry?
Yeah.
I'm saying the sales of rupee bonds which are rated below AA have dropped almost 20% so far this year. And this is the lowest that we've seen since 2013. However, issuances of notes rated AA and above has remained high at a high level historically in 2021. I think it made up for about 75% of the total sales. So is this again a trend that is expected to continue?
Yes, at least for the next 2 years it will continue. People are very comfortable about our economy. It's likely to definitely continue. So you don't know how far the balance sheets have improved in corporates. And this is the first year we are seeing an ascent recovery in our GDP growth. And corporate balance sheets will have to get adjusted from the pre-COVID levels to current level. It will take at least another 1 more year. Till such time, it will continue. You might have to pay a higher rate for that.
Right. And do you think that the interest rate cycle has bottomed out and probably the central bank will start increasing the reverse repo in the last quarter of this fiscal year and start to withdrawing excess liquidity?
Yes, I think so, because you see the sign is very clear. The August 27, they had a 50,000 crores 7-day repo operation, which has actually the cutoff was around 3.38%, which is very close to the reverse repo 3.35%. It means very clearly that Reserve Bank doesn't want to take money which is far higher than the reverse repo rate. One, it has come down from 3.54% to 3.35%, 3.38%. And one more thing is that is visible is that Reserve Bank is becoming more aggressive in mopping up funds from the market. The
Mhm.
VRR, initially it was 2 lakhs crores, 3 lakhs crores, and now the next September end VRR auction is going to be 7.5 lakhs crores, 4 lakhs crores. So totally this month alone, it is going to be 7.5 trillion rupees going to be taken out from the market through variable repo rate auctions. So it means that the Reserve Bank is very particular that excess liquidity has to be mopped out, because this actually stops the ability of the Reserve Bank to intervene in the forex market also. If you are going to allow the more and more liquidity. So it is almost double the normal liquidity with which the RBI will be comfortable. Normally, RBI is comfortable around 6 lakhs crores, 6.5 lakhs crores maximum. Now it is almost double. So naturally, I expect the repo rate to be, gap between the repo rate and the reverse repo rate to be reduced to the normal 0.5%.
Yeah.
Then probably by the end of this year or December or something like that, we may see the first rate hike in repo rate.
Right. So would this actually make the yield curve flatter and move short-term rates more than the long-term rates?
Yes, the short-term rates will first move up, and the long-term rate will take some time to go up. See, one more thing is that you see the 10-year, the Reserve Bank GSAP options. If you see the GSAP options in the 10-year, the RBI has mopped up a lot of 10-year bonds from the market. It means those bonds are not going to be traded in the market, and tradable 10-year bond volumes have come down.
Mm.
That is one of the reasons why you don't see volatility in the 10-year market. It has been just around 6.2%.
Correct.
There 4 or 5 basis points every day. So unless there are more 10-year papers on in the market, you won't see much of volatility there. And it will take some time for the Reserve Bank to really go to a sustained rate hike. I think repo rate hike will not happen immediately. First, reverse repo will go up.
Hmm. And overall, so then if you have to look at the sovereign and corporate debt, what's the kind of move you're expecting on the yields if you have to take a time frame, say till end of March?
Yeah, I've not been closely following that, but normally you can expect a 1% gap.
Hmm. Hmm.
In the history, 1% gap has been the history.
Okay. And overall, if you go to see in terms of where the increased activity on the supply side goes in the bond market, uh, there is a widening gap between demand and supply situation in FY22, which is almost to the tune of almost 3 lakh crores if you account for the GSEC acquisition program as well. And there's an additional 1.6 crore that is anticipated in the bond market. How much of this would actually require RBI support?
See what is happening. Initially, the government had budgeted 12.05 lakh crores gross borrowing in the market. But in the first quarter of this year, only 18% of the budgeted fiscal deficit they have gone into the market. It's just a 2.4 trillion worth of bonds they have purchased from the market. And now the current quarter, the Reserve Bank will also be buying 1.2 trillion from the market from the government as part of the repayment and other things. In addition to that, you may have to, the government has to borrow 3.4, so approximately 3 to 4 trillion crores of worth of bonds from the market. But fortunately or unfortunately, the government finances are pretty good. Right now, we have seen the tax collections are good. And on the expenditure side also, the first quarter, normally the government does everything in the first half of the year, whatever expenditure they allocate and they start spending. But this time in the first quarter, the government infrastructure spending has been low, pretty low. Whether they are going to pick up later on, we don't know. It could be because of the COVID lockdown and things like that.
Mm,
If
mm.
the trend is going to continue, then government borrowing also will not be to the estimated level. Net borrowing, they have predicted 9.5 lakhs crores. Even that may be lower in the current year because the tax collections. So which
Mm.
means that the Reserve Bank has got more liquidity to handle, and they got to be very aggressive in the coming quarters.
Right. And overall, with regards to where India's inclusion in the global bond index goes, anticipation is early 2022. Uh, what do you think? How will it impact? And secondly, what's the kind of flows that we could expect in the country on the back of the inclusion?
So next year, it will be very liquid to say, I mean, very difficult to say what is going to happen because what we also have to think is that the global central banks are already sounding the beginning of the tapering. Okay, slowly by I think by June, the full almost we will get a clear picture about whether the global central banks are going to taper. If the global central banks begin to taper, then we may see outflow from our market. So our bond market yields might also start rising, and the Reserve Bank will have to manage that.
Hmm. And then overall, the opening up of India's sovereign bond market for greater, foreign participation, does it actually hint that the policy makers are actually looking to promote growth through investment?
Yes, initially the growth will be through investment only, and the capital intensive investments will be the key for growth. Of course, the government is going in the right path, but what is really thing is that we need a better yield curve management techniques. Only then you will see, and liquidity is also very essential. That kind of scenario is very important before you go to the global market. Otherwise, it will be very difficult for the global players to come and invest in the market whenever they want to trade or something like that. Our market is not really matured enough to do it. But the GSAP type of operations will create a yield curve, manageable yield curve, so that and then liquidity has to be more improved at the various stages of the yield curve. Then only the global players will get interest in our market. Otherwise, it is very difficult.
Right. And very lastly, Mr. Srinivasan, what's the kind of impact that we could see on the Indian rupee on the back of all of this?
See, Indian rupee depends a lot on the strength of the Indian rupee, depends a lot on inflows. You will see majority of inflows coming into the capital markets is mainly because of the very fluid liquidity available in the international market. And it has been history that whenever there is a reversal in the liquidity, we also see a reversal in our stock as well as bond market. Some reversal will take place. But at the same time, FX management will not be that difficult because the Reserve Bank's got enough reserves. So volatility will be controlled, but there will be some outflows once the liquidity starts drying up in the international market. Tapering in full force. I mean, earlier tapering in 2013 it was only with the Federal Reserve, but this time the tapering, once the Federal Reserve starts, the other central banks also will start, like the BOE. I don't think the Bank of Japan will start, but the other central banks like Australian Central Bank, Canadian Central Bank, everybody will start. So there will be a reversal in the liquidity, and that has to be managed. And I think RBI is well prepared for it.
Right. Hopefully, that seems to be the picture from here on as well. Thank you, Mr. Srinivasan, so much for joining us on the show with your great insights Always a pleasure speaking to you. Thank you and stay safe.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.